Welcome to TaxLawGH and welcome to day 6 of our crash course series targeted at those sitting the May 2021 Institute of Chartered Accountants Ghana examination in taxation. This session is targeted specifically at those sitting the level 3 Advanced Taxation paper. Today's session will look at concepts around petroleum operations and mineral and mining operations. So these are two special industries which we refer to as the extractive industries. They have specialized rules when it comes to taxation, and it's important that we quickly revise some of these very critical rules as you prepare to sit your exam. Like I always say, this is a crash course session, and we do not expect that this session will materially cover everything you're required to know. But my point or my goal today is to give you some key things to remember as you are revising for your exam. So we'll use a past exam question from the May 2018 level 3 final level advanced taxation paper, as it was then called, the taxation and fiscal policy paper, to try and revise what we need to remember when it comes to minerals and mining taxation in Ghana, and specifically with reference to your level 3 examination. Now, what I'll attempt to do today is to give you, like I said, a quick reminder, a quick refresher of some things that you need to have at the back of your mind. And to help you memorize this, probably draw attention to some areas where the petroleum industry and the minerals and mining industry will be different when it comes to taxation. So where do they differ and how are they similar? Once you have these areas of similarity and differences, it makes your life easy. It makes it easy for you to memorize. So before we start, I want us to do something. Let's all head to the comment section in the live chat part, and please type where you are viewing from. Let me know where you're watching from. Let's have an idea what our audience is like. Where are you watching from? So if you're from Accra, just mention Accra. If you want to be specific, you can just say you're from Kanda, Kaneshi. If you're from Tema, let me know. If you're from Kumasi, Wa, Tamale, everywhere, just let me know which part of the country you're watching from. Let's have a fair idea where our audience really comes from for these crash course sessions. So, without any further introduction, let's begin to look at what we are required to do today. So the question we're looking at is from, like I said, the May 2018 exam sitting. You can see here, the question says the following data is relevant to the upstream petroleum operations of Lanandam Limited for the 2017 year of assessment. And if you've been following our series of lecture videos on the petroleum operations in Ghana with respect to the Income Tax Act of 2015, Act 896, you realize I mentioned that when it comes to the petroleum industry, it's organized along three main streams. We have the upstream, we have the midstream, and we have the downstream. Your examiner will seek to test you mainly or primarily on taxation as it pertains to the upstream petroleum operations side of things, right? So here, this question is asking about the upstream petroleum operation, and it says you are required to compute the revenue from the above and comment on the treatment of the sale of the petroleum assets as indicated above. So, like I said, we'll look at what the law says and we'll apply the law to solve this particular question. And that'll be for the petroleum side of things. And then we'll take one to on minerals and mining. So here, the company is called AB Limited. They're a mining company operating in Chebi in the eastern region. Then they gave us some details about the company, and they said required is to compute the taxes payable by AB Limited to the Ghana Revenue Authority and to comment on any two items as to why you allowed or disallowed it in your tax computation. This will also give you 5 marks. So let's look at these two first, right? And then we see any other thing we need to look at. Like I said, today's session is very specialized, it's very focused on the extractive industry. So if you have any question, obviously, feel free to leave the question in the live chats section and I'll get back to you on that ASAP. So let's look at, or let's remind ourselves what the law says, and then we'll come and apply our knowledge to solving this particular question. So let's quickly remind ourselves of what Act 896 says when it comes to the taxation of the petroleum and the mineral and mining operations in Ghana, as it has to do with our tax laws. So what do we need to know here? Let's begin to look at, especially for the petroleum operations, what the law says will qualify or will form part of the income of a petroleum operation when it comes to taxation. So the law is clear that these provisions are subject to Section 65 on exploration and development operations. If you remember, I told you that all expenditure that will be incurred in the pre-production stage is what is accumulated in a pool, and capital allowance is not granted on that pool of what expenditure, and that balance is carried forward from year to year, until production commences, at which point capital allowance will be granted at the rate of what, 20% on the reducing or on the straight line basis, right? 20% straight line basis. So the point I'm making is that over here, we are subjecting all of these inclusions of income items to Section 65 of the Income Tax Act. And once again, this provision on exploration and development operations or expenditure, we've clearly laid these out when it comes to the lecture videos on petroleum operations. I recommend that you watch those ones within these few days you have to exam to refresh your memory of all the key things you need to know. But here, let's focus on some really essential parts. So I'm saying everything I'm going to say here will be subject to those rules when it comes to what you can include and what you have to exclude. So we are saying the income of a person from petroleum operations for a year of assessment will include a number of things. The first is the market value of petroleum obtained from the petroleum agreement area that is disposed of during the year, or that is treated as disposed of during the year. So here we are looking at what? The market value. So here it must be the arm's length price. What is the price of the oil, of the petroleum on the global market? That is the price that will be used to value the oil for the purpose of taxation. So take note, is the market value, the arm's length price, right, of the petroleum obtained from the petroleum agreement area, which we define clearly. And I told you that a petroleum agreement, or a PA, is a contract that is signed between who? Someone known as a petroleum contractor on the one hand, and the state represented by the Ghana National Petroleum Corporation, right? And this agreement is what lays down the rules, the different agreements, the different procedures that will go into determining the amount of what taxes to be paid, the rights and obligations of parties when it comes to petroleum operations in Ghana, among several others. So take note, there is something called a petroleum agreement, and it's this document that will govern what the operation of petroleum activities in Ghana. So I'm saying that the petroleum agreement area really is the area that is the subject of the PA, as we call it, right? So the PA, or the petroleum agreement, will be tied to a particular area. So let's say there are different blocks of petroleum drilling areas in Ghana. We have the 10 fields, there's the West Cape 3 Point, different petroleum blocks, right? All of them are subject to different petroleum agreements, right? So I'm saying that the market value of any petroleum you obtain from that petroleum agreement area, that is either disposed of actually or treated as disposed of, will be added as what? Part of the income of the petroleum company from the petroleum operations. And take note, this is for the upstream side of things. What else will be included? Any compensation that is derived. So compensation derived, whether under a policy of insurance or otherwise, in respect of the loss or destruction of petroleum from the petroleum agreement area. So if petroleum that has been rightly obtained from the petroleum agreement area is either lost or destroyed, and you are compensated for that loss or destruction, that compensation will be included as income. Because take note here, you have not sold it, we agree. There was some destruction, there was some quantifiable loss, but that quantifiable loss you've been reimbursed for that loss. You've received consideration, right? So because of that, we are saying that yes, you did not sell it, but whatever you lost, you've received some form of value, some form of consideration for this, and we want to tax you on that. So any compensation derived, whether it is under insurance or otherwise, we are saying that as long as you've been compensated for a loss or destruction of petroleum, you need to include that amount received as part of the income from petroleum operations. What else will go into determining the income from petroleum operations? We also need to include any amount derived in respect of what? The sale of information pertaining to the operations of petroleum petroleum reserves. What do I mean here? Before companies begin to undertake core petroleum exploration or production, as we call it, commercial production, there are different phases that come before it, right? So they even need to do somewhat pre-production activities. So there's exploration, development. So here, they even need to do somewhat seismic procedures to find out, do we have petroleum reserves in this particular area? Does the seabed have enough oil that is in commercial quantities that I can exploit or explore for a period of time that will give me the maximum return possible for my shareholders? So within the process of trying to find out or explore and develop, right, it is possible that companies may come across some information. For example, a company that has undertaken exploration for, let's say, a period of 10 years before beginning commercial production, right, or before beginning or commencing operations proper. In such a case, such a company will probably have information towards the entire seabed of Ghana, right, when it comes to the area that has oil. And if another company wants to come to Ghana to drill, they may not have to go through the entire process. So they might say, okay, company A, I know you have information on the seabed, you know where the oil is. Do you want to sell to us that information to reduce the amount of work done? We are saying that any information you received as a result of petroleum operations, any intellectual property you have, any unique information you have, right? If you sell that information to someone else and you receive consideration from that, any amount derived from selling that will be included in determining your petroleum income. So take note, this money you did not get it from selling oil per se, but it's money you received from selling information, from selling data, right? And that information you sold, any consideration you received will qualify as part of your income from petroleum operations. Why am I emphasizing on this? The examiner is beginning to look at different ways of picking out different parts of the law to test students on. So don't be surprised where they give you a quick scenario, you probably may overlook it, but they tell you that during the prospecting stage or during the exploration stage prior to a commercial production, the company obtained data and they sold this data for this amount. You may not pick it up, but take note, the law is saying this amount derived from selling what information must be included in determining what the income from petroleum operations. What else do we need to include? Any gain from the assignment or disposal of an interest in the petroleum right with respect to which the operation is conducted must also be included. Now, an interest in a petroleum operation really, fundamentally at a very basic level, is what gives you the right to say you want to undertake a petroleum operation. So remember I mentioned there is a petroleum agreement or a PA. That PA gives people rights, right? So obviously, if you are a party to a PA, then you have rights to a certain contract area. If you sell a part of your interest, so let's say you have a 20% interest in a certain oil block in Ghana, and you sell 5% of that 20% interest you have to someone else, any gain you make from assigning, that's the technical term, or selling your interest in a petroleum operation to someone else, that gain you made is also an income from petroleum operations and must be added in determining your petroleum income for the year of assessment in question. So you can see here that really it's not just the oil you sell, but there are so many other things that go into deciding what will be part of your income from petroleum operations. So once again, take note here, any gain you make from assigning your interest or disposing of what that interest in the petroleum right, that will form part of your income from petroleum operations. What else? Any amount that is required to be included under Section 70, which deals with something known as the decommissioning fund, in respect of any surplus in a decommissioning fund, must also be included in your income. Quick revision. I didn't plan to revise or help you revise this, but it's worth it. The whole idea is that when it comes to the extractive industry, specifically the oil and gas industry, petroleum operations will have an effect on the environment, really, right? Will have a bad impact on the environment because you drill the seabed, it's possible there could be oil spillages and fish could die and all of that. We are saying that once you begin operations, begin to set aside money, begin to set aside funds such that at the end of your commercial production, at the end of your production phase, you need to use that money you set aside to what? Restore the environment to the state in which you met it before you started operations. And for the purposes of petroleum operations under the Income Tax Act, we call this fund the decommissioning fund. What the law says is that at the end of petroleum operations, any amount in the decommissioning fund will be used to what? Carry out decommissioning, and this amount will not suffer tax. However, if after carrying out decommissioning, there is a surplus left in the fund, that surplus must be added to your income and taxed. Let me use numbers to illustrate this. So let's say you have a decommissioning fund over your 20 years of drilling oil. You set aside money to the tune of $200 million. So this is the money you have in a decommissioning fund, right? At the end of your 20 years, when you have decommissioned, you have taken all your machines away, you've cleared the seabed, you spent 180 million to decommission. You can see that you had 200 million in the decommissioning fund, but you only spent 180. What the law is saying is that because you have spent 180, the extra $20 million is something known as a surplus in the fund. Because the fund has 200 million, you only spent 180, there's 20 million left. We did not tax you on that amount. Don't forget that the law said that all contributions to a decommissioning fund will be given as an allowable deduction. So if we give you an allowable deduction and you've not used 20 million, it's only fair. Give us our money back by what? Adding it back to your income from petroleum operations and suffering tax at what? The petroleum income tax corporate rate of what? 35%. So any surplus will be added to your income and taxed accordingly. In the same vein, if you make a loss or if you need to top up to make your decommission, then you'll be given what? A deduction. It's just fair. So on the flip side, if your decommissioning fund instead has what? 150 million and you have to spend 200 million to decommission, that extra 50 million will be given to you as a deduction if you have to what? Finance it from elsewhere. So that's the idea here. Any surplus in a decommissioning fund will be added to your income from petroleum operations and taxed accordingly, right? What else? Any amount received after production commenced as a reimbursement of cost and premium to a sole risk party under the sole risk terms of a joint operating agreement. What is this even about? Now, I'm sure you are very much aware that the petroleum industry or the oil and gas sector is a very high risk area. You could invest millions of dollars, if not billions, and lose everything because you could do exploration and development prospecting and find out that there's no oil there eventually. So you've wasted your money. So there's something called a sole risk operation. This is where someone says, you know what? I want to go and explore for oil in this particular area, but I want us to go together. So two people are speaking. One party says, oh, for me, I don't think I'm interested, or I don't think I have the appetite for this risk you want to take on. So party A will say, no problem, I will do this myself, right? So let's say party A spends $100 billion to do the whole exploration and find out that there's eventually oil. After party A spent 100 billion to find oil, party B now sees, oh, there's money in this thing. So they reach out to party A and say, oh, you know what? I think I've changed my mind. I want to now join you to explore. Party A will have in the agreement that since I did something called sole risk, it is called sole risk because what? I took the risk solely. I took the risk alone, right? So under sole risk agreements, the person who took the risk alone will tell you that, you know what, I'm going to charge you a premium. That premium can be something like 3 times. So I'll tell you that, you know what, if you want to join me, pay me 3 times how much I spent. And it is something people will pay. It can be 4 times, right? People will pay this because the person took the risk alone and you can't just jump on the wagon and want to enjoy. So we are saying that any amount you receive after production has commenced as a reimbursement of your cost and premium to a sole risk party will be income. So here I'm saying that you spent 100 billion alone. Then someone came to you, say you're going to charge them times 3. So they ended up paying you what, 300 billion. That extra above the 100 billion is the premium that you need to add to your income because you've made money from petroleum operations. Yes, we know you made the risk alone, but that premium you've made is income and we want to tax you on it, right? Someone may say it's not fair, I took the risk alone, why are you taxing me? But well, it is money you've made and we need to find a way to tax you on that. So what else do we need to know when it comes to this particular area? Still under income from petroleum operations, we need to remember that the law also says that any other amount derived by the person during the year from petroleum operations or incidental to petroleum operations that are included in calculating income under any other provisions under the Income Tax Act. Once you have any of these other income items, we will include them for the purpose of what's computing your assessable income from petroleum operations for the year of assessment. You are saying note. Remember, I mentioned market value. What is market value here? We are saying this is the amount that is determined in accordance with the method prescribed in the particular PA. Right. So the PA is king. It will determine among several other approaches how to value oil, and then it should not be less than what? Should not be less than the value receivable in a transaction that satisfies the requirements of section 31. Take note that deals with what? The arm's length standard and arrangement between associates without any discount, commission, or deduction. So long story short, we want to use the fair value, the arm's length price. If two unrelated independent parties were dealing and selling oil, would they sell at $100 per barrel? If yes, then that is the price, right? So here we are encouraging the price to, as much as possible, be the fair market value. And the exam question, would you realize that we would try and use this principle because the examiner gave us 2 values. One was in the market value, one was the market value. So here you need to remember that the principle is that market value or the price of oil should be the arm's length value. And take note, this will have transfer pricing implications if you do not use the market value. The GRA has a right to recharacterize any amount that is not at arm's length, or that is in contravention with what we call the arm's length standard. So now that we know the income from petroleum operations, let's look at the deductions. What are the things you can deduct from petroleum operations? Really, this is the core of petroleum operations, right? What can you include? What can you deduct? But here I'm focusing on the key things you need to remember. It's a long list, but these are the must-know things for sure. So I'm saying subject to section 8, which talks about the general deductibility rule, and section 65, which talks about the exploration and development operations or pre-production. And this particular section, any person who calculates the income of another person from a separate petroleum operation for a year of assessment shall deduct a number of things from assessable income. Number 1 is what? Any annual rental charges and royalties paid by the person under the Petroleum Exploration and Production Act of 2016, Act 919, with respect to petroleum operations. I'm sure if you are going through past questions, you would have seen so many times royalties at what? 5% on the gross production value or on the gross revenue from what? Oil. Perfect. What we are saying here is that that royalty amount is a deductible expenditure. Take note. So yes, all your past questions will tell you the answer 5%, yes. But remember that the law says specifically that that royalty amount is deductible as what? An expenditure or deduction from operation. Also, annual rental charges, right? You are required to pay some amount per block of what? Petroleum operation. There are figures around, I don't bother about that. But each block under each phase of what operation, first extension period, second extension period, all of that, initial exploration period, have their per square kilometer amount you need to pay, right? All those amounts are also deductible expenditure when it comes to what petroleum operations. What else? Capital allowances, and you can't go wrong with this. All of us know this, right? Capital allowances granted with respect to the petroleum operation and calculated in accordance with part 2 of the third schedule. Remember, the third schedule is what deals with capital allowance, but part 2 of the third schedule deals with capital allowance for the petroleum operation. And I'll give you a refresher here because you need to know that as well, right? And then any contributions to and other expenses incurred in respect of a decommissioning fund for the petroleum operation in accordance with the rules established for that fund. Remember, I mentioned that what deductions or donations to the fund are deductible expenditure, which is why if there's a surplus at the end, the law said clearly you need to include that surplus in determining what your income from petroleum operations for the year of assessment. What else? Any expenses incurred by that person in the course of closure of the petroleum operation where funds in the relevant decommissioning fund are not yet available or are inadequate. Remember, I told you that I gave you a scenario where you need to decommission or you need to close operations, and how much you spend is more than how much you have in the fund. We are saying that that excess, right, will also be given to you as a allowable deduction. I gave you numbers to support that, so that isn't a problem at all. And then any other amount incurred directly by that person in the course of petroleum operation, which amount may be deducted and the other provisions of the law can also be deducted. However, there's something we need to know. There are some things that you cannot deduct, and please pay attention here because the examiner finds ways of testing it. What can you not deduct from petroleum operations at all? The first is a research and development expenditure. And here, please, 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 please pay attention. If you read section 13(1)(3) of the Income Tax Act, Act 896, it says one thing, that when it comes to research and development expenditure, one, any research and development expenditure that meets the requirements of deductibility, i.e., wholly, exclusively, and necessarily incurred, may be deducted irrespective of whether the expense is of a capital nature. So the law has said that all R&D or R&D expenses are deductible as long as they meet the criteria of what? Being wholly, exclusively, and necessarily incurred, whether or not they are of a capital nature. However, when it comes to petroleum operations, the law is clear. You cannot deduct research and development expenditure for petroleum operation. I've seen this being tested at least 3 times so far. In 2 cases, they will ask you to give the tax treatment of research and development expenditure for petroleum operations and mining operations. The other one, they added R&D as part of the expenses to see if you have to disallow it. So please remember, R&D expenses are not deductible for petroleum operations. Remember this. What else? Any amount that is not wholly, exclusively, and necessarily incurred in the acquisition or improvement of a valuable asset will not be deductible as well. Or any amount that is not wholly, exclusively, and necessarily incurred in acquiring services will also not be deductible. And any amount that is income of the recipient which has a source in Ghana, if the amount contravenes the arm's length standard in section 31, and then if the amount is a bonus payment made in respect of the grant of a petroleum right, or for any expenditure incurred as a consequence of a breach of a petroleum agreement. So if you make any of these payments, these amounts cannot be deducted. They are clearly deemed, or they are in line with what the domestic and excluded expenditure under section 130, right? So that is the principle here. You cannot deduct any of these. Please have them at the top of your mind that these amounts are not deductible. So we know what you need to include in petroleum operations, what you need to deduct. Let's quickly look at what the law says about the mineral and mining operations. What can you include in your income? And you realize here, interestingly, that it has a lot of similarity with the petroleum operation. So we are saying subject to section 79, which deals with what? Reconnaissance and prospecting operations. What you can include includes a number of things. The first is what? Any amount derived or treated in section 31 on the arm's length standard as being derived from the disposal of minerals obtained from the lease or licensed area. So any amount which is the fair market value obtained from the disposal of minerals obtained from the area of what? The mining lease will be what? Added to your income. In simple terms, how much you get from selling the minerals will be added to your income. Similar to the petroleum one, any compensation that you derive, so you can see they are very similar. Any compensation derived under a policy of insurance or otherwise in respect of what the loss or destruction of minerals, same as the oil, right? Similar provision. The next is what? Any amounts derived in respect of the sale of information pertaining to the mineral operations or mineral reserves, same information. If you sell the information, you have what? You add it to your tax income, right? Or add it to your taxable income for the period. What else? Any gain from the assignment or disposal of an interest in the mineral right with respect to which the operation is conducted. Similar provision, if you assign your interest or you dispose your interest in the petroleum operation, that any gain you make from that is also what? Included in your income. Then what the petroleum operations will call a decommissioning fund, the mining guys will call a rehabilitation fund. The principles are exactly the same. Just change the name to rehabilitation fund and you have your answer. What do I mean? You contribute to a fund, use the fund to clear the land, clear the area, take off your machines. When you are done, how much you have in the account. If you use more than that, we give you that extra you use as what a deduction. If you use less than that, then the surplus is what taxable. So it's the same principle here, just that we are calling it what rehabilitation funds. We are saying that any amount that has to do with what a surplus in an approved rehabilitation fund will be included in your income from mining operations and taxed accordingly. And then any other amount derived by the person from any other provision under the Income Tax Act that must be added to their income will also form part of their income from mineral and mining operations. What do we need to deduct when it comes to mineral and mining operations? And watch this, very similar, right? Subject to the general deductibility rules, what you can deduct includes what? Ground rents, right? So similar to what the mining guy and the oil and gas guys have, the mining will call theirs ground rent. And once again, royalties. And I'm sure a past question to has told you this is still what? 5% on the gross mineral won, right? So this amount is what included as part of your deductible amount, and you have to take this out of what the deductions for the period, right? And then what else? Any capital allowances granted with respect to the mineral operation and calculated in accordance with part 3 of the third schedule. Remember I told you part 2 under the third schedule has to do with petroleum, capital allowances. Part 3 has to do with what? Mineral and mining operations. What else? Any contributions to and other expenses incurred in respect of an approved rehabilitation fund will also form part of the deductible expenditure for mineral and mining operations. And then any expenses you incurred in the course of reclamation, rehabilitation, and closure of the mineral operations where the funds in the approved rehabilitation fund are not yet available or are inadequate. So this is where you top up with the rehabilitation fund because you don't have enough money in the fund. We are saying that amount you top up will be given to you as a deduction. What else do you need to know? Any other expenses incurred by that person during the year that may be deducted under the Income Tax Act will also be given to you as a deduction. So very similar provisions to petroleum operations, and I'm treating them side by side so that you are able to know that, oh, if I know one, I really know the other. I just need to know which terms apply where, right? Then what amounts can you not deduct, and watch how it's similar. Guess what? The first one is also what? Research and development expenditure. So the rule is the same. Section 13 of Act 896 says all research and development expenditure that is wholly, exclusively, and necessarily incurred can be deducted, whether or not they are of a capital nature. But hold on, oil and gas or petroleum operations and mineral and mining operations are saying that no, you cannot deduct R&D expenditure, and that is the case for them. You can't deduct when it comes to these two operations. So please remember the special rule for R&D expenditure under petroleum operations and under mineral and mining operations. What else? Any amount, same principle, that is not wholly, exclusively, necessarily incurred for both getting an asset or for incurring what an expense. And then any amount that does not comply with the arm's length principle or the arm's length standard will also not be deductible. Same for the bonus payments made and any expenditure incurred as a result of breaching an agreement. So if they take you to court and you have to pay damages for breaking the petroleum agreement or the mining lease, or what's technically called in practice the investment agreement, you cannot use that amount and say you're going to deduct it, right? You have breached an agreement and that amount should not be deductible ordinarily, right? So this should cover the deduction. Now let's look at capital allowances for both petroleum and mine operations before we go back to the past question we started to look at, and then we look at solving that. What does the law say about capital allowances when it comes to petroleum and mining operations? Here I've picked the very essential things to give you a quick summary, right? There are lots of rules, but what must you know today as your exam date is nearing? For petroleum operations, key thing to remember is that what a person who incurs a capital allowance expenditure in respect of a separate petroleum operation during a year of assessment is required to place the expenditure in a separate pool of depreciable assets. So put the expenditure in a separate pool. You're not going to follow the whole class 1, class 2, class 3, class 4, class 5. No. Create a separate pool and put all your expenditure in that single pool. And then the Commissioner General will grant the person capital allowance with respect to each year of assessment at the rate of 20% using the straight line method. Remember this 20% straight line method. Okay. And please, this is where you need to focus super well. Like, look at this thing well, because I'll show you something shortly under mining, and there's a big difference here. Big difference. It has been tested in the question we're going to look at, so please watch it. So we are saying here that where an asset for which capital allowance expenditure has been incurred, right, for a separate petroleum operation is disposed of or treated as disposed of during the year of assessment, the Commissioner General shall compute assessable income from the separate petroleum operation for the year include what? Consideration received. Please, let's make a note of this. I'll come back to it, right? It means when you sell a depreciable asset, when you dispose of a depreciable asset, the consideration received from disposal must be included in your income. Take note, it is the entire consideration received, not the net proceeds. Add the whole consideration received to your income, and then you tax that. I'll talk to you about something shortly, so let's keep going. Also, we are saying where in a year of assessment an asset is partly used in a separate operation and partly used in another operation, you need to apportion the capital allowance. So if you use a particular machine in oil block A, the same one in oil block B, you need to apportion the capital allowance between this block and this block with respect to the proportion you use in block A and the proportion you use in block B. So if you use a 50-50 in both oil blocks, then you share capital allowance for them 50-50, but use a proportion of usage of the assets in the respective blocks. Still under petroleum operations, we are saying where in a year of assessment a person assigns their petroleum right to another person, then the written down value of any capital allowance expenditure they had at the beginning of the year is also transferred to the assignee. So remember I told you the assignment of interest, when you make a gain, right, you need to include that gain from assignment in your income from petroleum operations. When you assign your interest or you dispose of your interest, the person who is acquiring that interest will also need to pick on or acquire your capital allowance. And here we are saying that you need to give them the proportion, right, of the written down value at the beginning of the year of any asset you are transferring, right, or as part of the right you are transferring. So find the proportion of WDV, written down value, at the start of the year and assign this appropriately. Also, when in a year of assessment, the person assigns part of the petroleum right, then they will apportion the written down value in proportion to the percentage of interest retained and the percentage of interest assigned, right? Obviously, so if you've sold 50%, then 50% out of 100% of the amount of written down value of capital allowance is what you transfer to the recipient or the assignee, right? So also we are saying that when the person is calculating their income, any deduction that is made in respect of capital allowance, right, they will not make a further deduction with respect to the same capital allowance expenditure under any other provision. It means if you get a capital allowance deduction under this particular provision for petroleum operations, you can then go and rely on the general one for other companies as well. It will not fly, it will not work. Okay, now let's look at for mineral and mining operations, and please pay attention. I'll show you something shortly. For them, same thing. They will place all their expenditure in what? A separate mineral operation pool, separate pool, right? And grant capital allowance on that particular expenditure. What rate? Same as the petroleum guys, 20% on a straight line basis, right? Okay, and please, this is where you need to focus. What I was talking about, moment of truth has arrived. Where an asset for which capital allowance has been granted is disposed of or treated as disposed of, the Commissioner General shall what? Please watch this carefully. Shall, if the consideration received for the disposal exceeds the written down value of the amount, include the excess in computing assessable income. So for mining, we don't, remember I said for petroleum, what do? We include the gross consideration received, the gross proceeds in determining income. Under mining, we don't put the whole proceeds here as part of your income. It is just the gain we add. So remember we are saying that if the consideration received exceeds the written down value, then the excess will be given to you as what? Income. So let's say the proceeds or consideration received is what? 1 million. The written down value is 0.5 million or 500,000. The extra 0.5 million is what will go into determining what? Your income from mining operations. However, if it were to be petroleum, it is the whole 1 million consideration without deducting cost. Do you get it? That's a big difference here. Please remember this, right? It has been tested and the question will do today. You see it in action. It comes a lot. Know the difference between when it comes to disposal of depreciable assets under mining and under petroleum operations. The big difference. This is it right here. Also, if the written down value, this is the mirror image on the opposite side. If the written down value now exceeds the consideration received, then you'll be given an additional capital allowance for the year, right? So if here you make a loss, technical loss on disposal, then we find a difference and we give you a capital allowance with respect to that particular difference, right? And then we reduce the pool of depreciable assets referred to above by any written down value of the asset. Then the rules around assignment of interest, same old. So here, before we even get to assignment of interest, we are saying that where a person uses an asset part in a different operation and partly in another petroleum and mining operation, what are you required to do? You are required to what? Apportion the capital allowance expenditure in proportion of what the amount or quantity or proportion used in mining operation A as opposed to what? Mining operation B, in that particular order. Then when you assign a mineral right, same old, it is what? The written down value at the beginning of the year that is transferred to the assignee, just like you have it under petroleum. Nothing has changed here for mining. Then if you assign part of your interest instead of the whole interest, then we apportion the written down value at the start of the year, right, in proportion to the percentage of interest retained and the percentage of interest was assigned, right? So this is it for mineral and mining operations and petroleum operations. So now that we know these rules high level, let us go back and let's try and apply these rules to see if we can solve the question that has been given us by the examiner. So let's go over and complete the past exam question. So let's apply our knowledge, what we just acquired, to solving these questions, right? So the first question, let's read through. It says, let me just clean everything we highlighted and let's start over again. Good. It says the following data is relevant to the upstream petroleum operations of what? Lanandam Limited for 2017. Required, compute the revenue from the above and comment on the treatment of the sale of petroleum assets as indicated above, 5 marks, right? So they said 200,000 barrels of oil sold internationally at $68 per barrel. Can we agree that this is the market value? right? Remember we said this should be the section 31 arm's length price. Do you remember? So if that is the price on the market, then we use that. So 200,000 barrels of oil sold at $68 per barrel. That's what we use, right? Next is an asset bought at the inception of petroleum operations was sold for what? $1 million in 2017. Remember I told you that the law said you need to add the whole proceeds amount. Do you remember? Because it's petroleum, we will not deduct cost. We'll add the entire proceed amount here. So if it was a mining company, you have to deduct for the written down value of what? Expenditure before putting the gain in income. If it's a gain, if it's a loss, you give them additional capital allowance. But here, because it's petroleum, we'll add the entire gain because that's what the law says. So please be careful. Here, the examiner wants to see, do you know the rules for petroleum? Do you know what the rules for mining, right? So we'll have to add the whole amount here. Then the next one is what? 50,000 barrels of oil lifted and sold to the parent company in the US. So here, because it's parent company, beginning to think about what? Is it arm's length? Are they persons in a controlled relationship? Yes, they are. So are they dealing at an arm's length? If not, we need to use the arm's length price. And fair enough, they said what? They agreed to sell at what? $56 per barrel. However, the price ruling on the international market was what? $60 per barrel. The law says we should use what? Market value. So the question says determine the revenue. Very simple. Let's do this. So, as always, I want you to write the company's name. So the company is called, let me come here a little bit. Lanandam Limited. Right? So, determination of revenue from petroleum operations. Okay. So simple. We have what? Or let's even add it for the 2017. Yeah, they gave us. So for the 2017, always add a year of assessment when it's given. Year of assessment. Okay, so we've been given what? It's in dollars, right? So this is in dollars. We have 200,000 barrels of oil at what? Right here, $68 per barrel, is it? Let me clean this so I can see clearly. So at what? $68 per barrel is 200,000. So just at $68, what would that give you? Multiply 200,000 by 68 and you have your value. That's all. So let me do this. 200,000 times 68 will give me $13.6 million. So I put here 13,600,000. That's it. Next is what? They said an asset bought at the inception of the petroleum operations was sold for $1 million. So I'll just say what? Proceeds, or into brackets, what? Let's just say consideration received. That's the technical term. Consideration received from what? Asset sale. Right? And how much was it? They said $1 million. So I put here $1 million. Right? What else? They said we also what? 50,000 barrels of oil were sold to the parent at $56, but the international oil market price is $60. So let's use the international oil market price of what? 60, and not what they decided to use among themselves. So we have what? 50,000 barrels at international price of what? $60 per barrel. So we just need to find what? 50,000 times what? 60, and that'll give me $3 million. So ladies and gentlemen, when you add all of these three, that should give us 13, the 16, the 17.6 million. So 17.6 million. Ladies and gentlemen, this is the revenue from petroleum operations. So we'll say revenue from petroleum operations. If you can do this, you're almost there. But the examiner said what? Compute the revenue and comment on the treatment of the sale of petroleum assets. So we just mentioned that what? The law is clear. The Income Tax Act provides that what? Any proceeds from the sale of what? Depreciable assets during the year must be included. The consideration received, right, must be included as part of what? The income from what? Petroleum operations. So please be careful. Mention this, that will just comment on it, that you need to add it as part of what? The accessible income from petroleum operations. And once you mention this, just a sentence or two, you have your full 5 marks. So this is the principle they wanted to test here. Number one is, do you know which price should be used? Is the fair value or the market value of the petroleum. Next is what? That when an asset is disposed of, we need to use what? The full amount, or we need to include the full amount as part of what? The income from petroleum operations. Please remember, this is very, 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 very important, right? Okay, let's do the second question. So the second question says, AB Limited is a mining company operating at Chebi in the eastern region. Okay. So they are a mining company located at Chebi in the eastern region. The following data is relevant, right? So they have revenue. Please take note, this is a mining company. We've shifted from petroleum. So put on your mining cap now and let's begin to do some magic here. So they have revenue of 20 million cedis. Cost of operation including expenses, 14 million. And then there's a margin of what? 6 million. This margin is clearly what? The profit, right? They made on the operation. Then they are saying royalty has not been computed and paid on the above yet, so we need to compute that. Depreciation of an amount of 1 million was part of the cost of operation. So they are saying this cost of operation here, take note, this amount includes what? Includes depreciation. So we need to strip it out, right? Okay. And then proceeds from the sale of depreciable assets amounting to $500,000 were added to revenue. Remember, this is mining. For mining, you don't add the proceeds to revenue. You add what? The difference between the proceeds and what? The written down value. The difference between the proceeds and the consideration, difference between the consideration received and the written down value. Here, they have added the entire proceeds to revenue as if it's a petroleum operation. It will not fly here. We need to what? Reduce it or take it out, right? So let's flag this on the side, that proceeds of depreciable assets of 500,000 added to revenue. So we know here there's some 500,000 we need to what? Take out. Yeah. And then we are saying here that capital allowance agreed with the mining unit of GRA was 800,000. So this is a gift. You just need to deduct capital allowance. You don't need to compute. This is capital allowance under part 3 of the third schedule computed for you, 800,000. What is the requirement? Compute the taxes payable by AB Limited to the GRA and comment on any 2 items as to why you allowed it or disallowed it in your tax computation. Very easy. Very, very, very easy, right? So let's get to the question and let's start, right? So here, what do we need to do? The company is called AB Limited, right? So what are we required to compute? For AB Limited, we are required to compute what? The taxes payable. So we can just say computation of taxes payable. So as usual, you would have started with what? Your profit before tax. But here we have the margin. So let's say, what is the margin? We have a margin of right here, right? Let me change this to... I have a margin of what? 6 million, right? So we take the 6 million. Then as usual, they said what? This amount includes depreciation. Can you see? What's the depreciation value? They said depreciation of what? 1 million was added. So we need to add back depreciation, right? We need to add back or disallow depreciation. So we add back our depreciation of, they said it's what, 1 million, right? Okay, now that we've added back depreciation, how do we treat the other items? Watch it carefully. They are saying that what? Proceeds. Let me take this out. So let me experiment. Let's use this. Okay. They are saying what? Proceeds from the sale of depreciable assets of $500,000 were added to the revenue. So it means the revenue figure right here of 20 million, right, includes what? Some 500,000 for proceeds, which shouldn't be there. Because don't forget, you shouldn't be adding the proceeds. So we need to deduct this from the margin, right? So we need to less our proceeds from asset disposal. And they said it is what? 500,000. So we take this out, right? What else must we deduct? Do you remember that we said what? Any royalty payable or any royalty paid is a deductible expenditure. Do you remember when we were looking at the amounts that can be deducted and what mine? We said what? Ground rent and royalty, right? So we need to less also, what? Any royalty payable. We know that royalty is paid on 5%, as is paid at the rate of what? 5% on the gross value of minerals won, right? Obviously subject to any specific rates in the mining agreement or the mining lease they may have. So here it would have been, let's watch here. So you know the revenue they gave is what? They said the revenue is 20 million. But do you remember they said that what? If you watch here, proceeds of 500,000 were added to the revenue. So if you compute 5% on that figure, you are computing royalty on the proceeds from the sale of the asset. So you need to remove the proceeds from assets from the revenue before you compute the royalty figure. So our royalty will be 5% on what? The 20 million after deducting what? The 500,000. Do you get it? And this 500,000 is what I got here, this figure here, from the proceeds of asset sale. My job is to compute my royalty, so I need to strip it out first. So this will essentially be what? 5% on what? Difference between 20 million and 500,000. That is all. And that clearly gives me 19.5 million. So 19.5 million times 5% gives me what? 975,000, right? So my royalty is technically 975 thousand. I need to deduct that as well. Then do you remember the question gave me here? They said what? Capital allowance agreed with the GRA mining unit is what? 800,000. So I deduct my capital allowance as well. So less capital. So all we are applying here is what? The rules that we went through together, right? The capital allowance is 800,000. So I take out my 800,000. So let's net everything together. So it's essentially going to be my what? My 6 million. 6 million plus 1 million. 1, 1, 2, 3, 1, 2, 3. Minus 500,000. Okay. Minus 975,000. Minus 800,000. And that gives me 4.725. So that gives me 4.725 million. So this will be my what? Chargeable income. Then I'll say income tax at what? Mining companies was the rate? 35%. So I apply what? 35% to 4,725,000. What does that give me? So times 0.35. That gives me 1 million. That gives me 1,653,750. And this is the amount of company income tax payable by the mining company. But hold on, they say compute the taxes payable. So we need to also compute the royalty payable. Don't forget that we gave it as a deduction. So what is the amount payable? So we say our royalty payable will be what? Remember I said, is this same figure here? It's 5% on the revenue after deducting what? The proceeds on disposal. That's all. So the 975 here we got, that will be our royalty. So this becomes what? 5% on the difference between the 20 million gross revenue less any what? 500,000 of what was the figure? Proceeds from sale of depreciable assets, and that gives me what? As we found at the top here, we got 975,000. So this is my royalty payable, right? So at this very fundamental level, my total taxes payable would then be what? The summation of these two figures. So 1,653,750 plus my 975,000 will give me 2,628,750, and this is my tax payable. But we are not done. What the examiner say? They said we should what? They said we should compute the taxes payable, which we have done, and comment on any two items as to why you allowed or disallowed it. So please, here, over to you. Why are we allowing or disallowing anything? So let's start with this one. Let's start with depreciation. That's the easiest. We are disallowing it because what? It is deemed to be an excluded expenditure under section 130 of Act 890. So the law is clear that depreciation is what? An excluded expenditure that must be disallowed. So that's my first item I'm commenting on, which is why I'm what? Disallowing. Then proceeds from asset disposal. Why I'm deducting it is what? The law says that it is what? Petroleum operations who are allowed to add the gross proceeds or the gross consideration received as part of their revenue. For mining companies, it is not the gross they must add. It must be what? The consideration received less any written down value. So that's essentially the gain on disposal. So I have to less that as well. And I've done mine too. You can end it here. But if you still want to talk about it, what else you've deducted is what? I've deducted capital allowance, and under section 14 of Act 896, I'm allowed to deduct my capital allowances as prescribed under the third schedule. Specifically for mining companies, the part 3 of the third schedule will deal with what? Capital allowances. Then royalty is an allowable deduction under the Income Tax Act when it comes to what? Mining companies. So these are the things you can talk about, and then you should be fine. So these will cover this area. When it comes to this topic, what I recommend you guys do is please take as many past questions as you can, and then try to look at different scenarios. Look at how the examiner solved it. It will give you a very strong footing. It will give you a very strong basis on how to approach this topic going forward. It is not difficult. It is just principles based. What I recommend also is take some time to go through the videos on petroleum operations and mineral and mining operations. They are not long videos, right? Go through them. Make sure that you have covered everything there. What we did in those videos is to ensure that as long as that thing is in the Income Tax Act, as long as it's in the income tax regulations, we covered it in those videos. So you know that when you watch them, you at least cover to a very large extent to the exam, and then you can sit your exam with confidence. So please go through past questions, practice the past exam questions, and look at our videos on these particular topics. So this should really bring us to the end of today's session. What I want you to do is let us know how the crash course sessions have been of help to you. You can leave a comment, and that should help us significantly. So if you love this as usual, don't forget to smash that like button, and don't forget to share this video within your entire network. It's been fun. It's been exciting bringing you all of these days of the crash course session. We really wish you the very best of luck. We wish you the best of success. May your efforts be crowned with all success possible. And please go and smash that tax paper in May 2021. All the very best in your exam, and we'll catch you in our subsequent video series. It's bye-bye for now.